February 2025. The Trump administration slaps a 20% tariff on Chinese goods, escalating trade tensions. The United States makes a bold move slapping a 20% tariff on Chinese goods. It's the latest escalation in a trade war that has already caused serious disruptions across global markets. But China isn't just going to sit back and accept it. Within weeks, Beijing retaliates hard. U.S. imports are cut dramatically while China strengthens its trade ties with Canada and the European Union. The result: American businesses lose access to one of their largest markets, while Canada and Europe step in to fill the gap. The question is, was this a strategic miscalculation by the U.S., or is there something bigger at play? One of the most immediate and dramatic shifts happens in the energy sector. For years, the U.S. was China's top supplier of crude oil and natural gas. American energy exports to Beijing were booming, and both sides benefited from a steady flow of oil and liquefied natural gas, LNG shipments. But in March 2025, things take a sharp turn. In response to the trade war, Washington hits Canadian oil imports with a 10% tariff, a move that angers Ottawa and forces it to find new buyers. That's when China steps in. Almost overnight, Beijing begins ramping up oil imports from Canada. The timing couldn't be better. The Trans Mountain Expansion, TMX, pipeline, which has been in development for years, is finally up and running, boosting oil export capacity from 300,000 barrels per day to an impressive 890,000 barrels per day. With a direct, cost-effective route to Asia now in place, Canada shifts nearly half of its crude oil exports to China. The impact is massive. In just a matter of months, Beijing has successfully reduced its reliance on American energy, while Canada secures a long-term buyer for its oil. But it's not just crude oil that's making its way to China. The liquefied natural gas, LNG, sector is also seeing a major shakeup. The LNG Canada project, one of America's largest LNG export facilities, is set to begin operations in 2025 with an annual export capacity of up to 26 million tons. Before the trade war, the U.S. was one of China's largest LNG suppliers, providing a steady stream of fuel for the country's growing energy needs. But after Washington imposed trade restrictions, China quickly pivoted to alternative sources. Canada, along with Qatar and Australia, is now filling the gap. The numbers speak for themselves. Chinese energy buyers, looking to diversify their supply sources, start securing long-term contracts with Canadian LNG exporters. The U.S., once a dominant force in the global energy market, finds itself losing ground. Beijing's strategy is clear: shift away from American suppliers, strengthen ties with other nations, and reduce vulnerability to U.S. economic pressure. And so far, it's working. While energy exports are one piece of the puzzle, agriculture is another battleground where China's retaliation is hitting the U.S. hard. China is one of the world's largest buyers of agricultural goods, and for decades American farmers relied on exports to China to keep their businesses thriving. But as tensions between Washington and Beijing continue to escalate, China begins phasing out U.S. agricultural imports. The hardest hit: soybeans. Back in 2016, the U.S. supplied around 40% of China's soybean imports. But by 2024, that number has plummeted to just 18%. Instead, China is now turning to Brazil and Argentina, which together supply nearly 3/4 of China's soybean demand. The shift is a major blow to American farmers, who are left with surplus crops and falling prices. And it's not just soybeans. Other key agricultural exports, wheat, corn, and cotton, are also being replaced by suppliers from South America and Europe. China is diversifying its import sources, ensuring that U.S. tariffs and trade restrictions no longer have the same leverage they once did. Even the meat industry is feeling the effects. Traditionally, the U.S. was a major pork supplier to China, but that's changing fast. Spain and the Netherlands have stepped in, capitalizing on China's demand for high-quality meat products. EU pork exports to China surged by 35% in 2023 alone, while American pork exports declined due to tariffs and stricter Chinese inspection policies. For American farmers, the consequences are devastating. Without access to the Chinese market, they are stuck with oversupply and plummeting prices. Large-scale farming operations may be able to absorb the hit, but smaller farms, which lack the financial flexibility to pivot quickly, are at serious risk. Many are facing financial strain, struggling to make ends meet, and even considering bankruptcy. The ripple effect is being felt across rural America, where agriculture is a key part of the economy. Meanwhile, the impact of China's trade shifts isn't just limited to farming. The broader U.S. industrial sector is also losing out. China, once a major investor in American businesses, is pulling back. Tech giants like Google, Tesla, and Intel are seeing their market shares in China shrink as Beijing pushes for more domestic alternatives. Chinese companies are investing in partnerships with Canadian and European firms instead, strengthening ties with BRICS nations and moving away from reliance on U.S. technology. The long-term impact of this shift is clear: a gradual decline in U.S. global economic influence. For decades, Washington dictated the rules of international trade, leveraging its economic power to shape global markets. But with countries like China, Canada, and the European Union forming new alliances, the balance of power is beginning to shift. The question now is, what will the U.S. do next? If Washington continues down this path, doubling down on tariffs and trade restrictions, it risks further isolating American businesses from global supply chains. China's aggressive push for trade diversification is already creating new economic alliances that could permanently reshape global commerce. The longer this standoff lasts, the harder it will be for the U.S. to reclaim its lost influence. For now, Canada and the EU are the ones coming out on top by stepping in to fill the gaps left by the U.S. They're gaining stronger economic ties with China and securing valuable trade deals that will benefit them for years to come. Meanwhile, American farmers, tech companies, and industries are feeling the squeeze, watching as their once stable markets disappear. This trade war is more than just a short-term dispute. It's a turning point in global trade dynamics. If the U.S. doesn't adjust its strategy, it could find itself losing its place as the world's dominant economic force. The big question is, will Washington recognize the shift in time, or is this the beginning of a long-term decline in U.S. economic power? China's decision to cut U.S. agricultural imports wasn't just a reaction to tariffs. It was a strategic shift that reshaped the global food trade. For decades, American farmers relied on China as a massive buyer of crops like soybeans, wheat, and corn. But as the trade war escalated, China didn't wait for a resolution. Instead, it found new suppliers, permanently reducing its dependence on the United States. Now, U.S. farmers are facing an economic crisis, while South American and European producers are cashing in on the opportunity. Soybeans were the first and most obvious casualty. In 2016, the U.S. supplied around 40% of China's soybean imports, making it one of the largest players in the Chinese market. But after years of rising tensions and retaliatory tariffs, that number collapsed to just 18% by 2024. Meanwhile, Brazil and Argentina stepped in to fill the gap. The shift wasn't just temporary. Chinese buyers signed long-term contracts with South American suppliers, effectively locking U.S. farmers out of one of their most profitable export markets. It wasn't just soybeans. U.S. wheat, corn, and cotton exports also took a massive hit. China diversified its import sources, strengthening ties with Argentina and Brazil, while also increasing purchases from European suppliers. The European Union, which once played a smaller role in China's food supply, saw its agricultural exports to Beijing skyrocket. And while American farmers were struggling with excess supply and falling prices, their European and South American counterparts were expanding operations to meet rising Chinese demand. The pork industry saw an equally dramatic shift. Traditionally, the U.S. was a major supplier of pork to China, with American farmers benefiting from Beijing's high demand for meat imports. But over the last few years, Spain and the Netherlands have taken over as China's primary pork suppliers. In 2023 alone, European pork exports to China surged by 35%, while American pork exports plummeted. The reasons for this shift were clear. China favored European suppliers due to stricter food safety regulations, more stable supply chains, and competitive pricing. For American farmers, this was a nightmare scenario. Losing China as a major buyer meant an oversupply of crops and livestock, which sent prices into a downward spiral. Larger corporate farms had the resources to absorb some of the losses, but smaller family farms struggled to keep up. Many farmers had taken on debt in anticipation of continued exports to China, and when those sales dried up, financial strain turned into bankruptcy for some. The reality was brutal. Without China's demand, the American agricultural sector was in crisis. The ripple effects didn't stop there. U.S. agri-giants like Cargill and Archer Daniels Midland saw their revenues take a hit as global trade patterns shifted. Warehouses filled with unsold grain, and the logistical networks that had once smoothly moved American crops to China suddenly faced disruptions. The trucking and rail industries, which relied heavily on agricultural exports, saw declining business. The entire supply chain, from farmers to shippers to processors, felt the economic strain. At the same time, China's shift away from U.S. agriculture was part of a broader strategy to weaken American economic influence. By cutting U.S. imports and forming stronger trade ties with other countries, Beijing was ensuring that future disputes with Washington wouldn't disrupt its food supply. This wasn't just a short-term response to tariffs. It was a long-term economic realignment. And it wasn't just agriculture that was feeling the heat. The broader U.S. industrial sector was also suffering. American technology companies, which once saw China as a key growth market, were losing ground fast. Google, Tesla, and Intel, companies that had built strong business ties with China, found themselves being pushed out. Beijing's new trade policies encouraged Chinese companies to invest in domestic tech development and source materials from non-U.S. suppliers. China was making a clear statement. It no longer wanted to rely on American businesses. At the same time, Beijing was strengthening economic ties with Canada, Europe, and BRICS nations, Brazil, Russia, India, China, and South Africa. By expanding trade with these partners, China was further reducing its reliance on the U.S. economy. Canada, in particular, was becoming a key player in China's strategy. With its massive natural resource exports and advanced industrial sector, Canada was quickly filling gaps left by American suppliers. The long-term impact of these trade shifts was clear. The United States was losing its grip on global commerce.